give an update on the greater NYC housing market? You previously mentioned a major downturn in the high-end markets like Fairfield County.
Yeah, so maybe 4 months ago, I think we did a sort of a deep dive in this, and even to go back a step further, one of the things we've tried to do over the last couple of years is we sort of pick a market every quarter, and we sort of do a bit of a deep dive. So back maybe a year and change ago, when oil was really, coming off the rails, we did a big look at the Houston market. And then with sort of tech being sort of past apex, we did a lot of work on the San Fran market. And then we looked at the Miami market with the dollar and what was happening with this FinCEN crackdown. And then, to your point, more recently, we looked at the New York market. And one of the interesting things we sort of looked at in the context of New York was New York, but even beyond just New York, what was happening at the high end. And for a number of reasons, the high-end market has been slowing down in a much more significant way than the rest of the market. In fact, the strongest part of the market is still the entry-level market, and that's because rents have been rising at rates sort of well in excess of broader inflation for many years now.
Yeah.
The market is still extremely supply constrained, and people, you've had sort of this structural inability of a lot of would-be first-time buyers to go out and obtain credit because they either don't have the requisite credit scores or they don't have the requisite down payments.
Yeah.
But that's sort of one of these things where time is going to sort of become your tailwind, right? Because eventually people's credit improves, people are able to save up a down payment, and that all facilitates them finally getting into that entry-level segment, which is where you see still the strongest demand. The high end, however, is the exact opposite. The high end is suffering on a number of fronts. The high end, it's a little unclear post the election whether all of this sort of upswing, certainly in market valuations and in sort of broader consumer confidence measures, whether that's going to ultimately manifest in the form of stepped-up increased luxury consumption, which flows through to the housing market.
Yeah.
So we're still sort of waiting for data, right? Because right now we're in early February. We're not really going to have a sense of this until we start seeing sort of the January and February data coming in.
Yeah.
Because you always get this sort of honeymoon phase that really lasts from sort of election to inauguration. But then the question is, well, how much of that is sort of directly translatable into actual consumption? And then you have to parse it between sort of the low end, the middle market, and the high end or the luxury segment. And so I guess long story short, the jury's still out here a bit on the New York market. But the data that we were looking at when we put this sort of big update together 4 months ago was very clear that inventory levels had stepped up significantly. The amount of new construction in, for instance, the Manhattan apartment market was going to be crushing over the next 5 years. And surrounding very affluent enclaves, places like Greenwich, Connecticut, New Canaan, Connecticut, Darien, Connecticut, all were seeing pretty unprecedented levels of month supply of inventory.
Yeah.
And interestingly, the further up market you went, the more crushing the oversupply.
Yeah.
So I think, for instance, in Greenwich, homes for sale at price points over $10 million had something like 120 months supply.
Yeah, wow.
I mean,
And you said it was the same thing like out in Long Island too, right?
Yeah.
Like the Hamptons and all that.
So yeah, I mean, there's been a number of stories recently about the Hamptons market cooling. So, and we've done a lot of work on this, but yeah, I think the big question mark now, again, is sort of, post-inauguration, what sort of flow through do we see, right? Because obviously you've got equity valuations, at or near all-time highs and climbing. And the idea, right, you have this sort of annuitization effect from a wealth effect standpoint that people tend to sort of annuitize something on the order of 3 to 5% of those unrealized gains annually. So to the extent that that actually flows through.
Yeah, this narrative applies to like everything too. I mean, you look at Like we were just, we looked at earnings a lot lately, and we kind of just did an update on Friday. But I mean, look at industrials; it's the outperformer since the election. That's the sector we see the relative outperformance. Like still, like if you look at a longer term window, obviously it's it's not outperforming. You had that huge kind of like commodity type of downturn, but I mean, earnings growth is nowhere. You're going on almost nearly 8 quarters of negative earnings growth in the industrial sector. It's supposed to be negative again in Q1. So this is it's really all just a narrative until you actually see some flow through in the data.
Yeah, it's interesting too. We got some data. We'll probably actually have a note out on this later today, but we got the January update on the Fed Senior Loan Officer Survey,
Yeah.
and that was conducted in the first couple weeks of January. So again, it's the most current read we've got. But what's interesting about it is that for the first time now, post the recession, you saw 2 big categories of credit where standards are tightening and demand for the credit is going down. Mm-hmm. And those are actually in the consumer sector for both credit card lending and auto lending. So, commercial real estate standards, lending standards have been tightening for a long time. Commercial and industrial lending standards have sort of been narrowly contracting, tightening to sort of flat. That was sort of, again, the case this quarter. I think what's happening there is basically you had this sort of broad-based retention to lending to the energy sector from really sort of, call it early 2015 until recently. And then the broader sort of complex of business lending has been sort of okay. But now you've got, the auto and credit card markets combined are close to $2.5 trillion in credit. So it's a pretty significant market. So it's a little unsettling to see standards tightening in those areas.
This come out, because we were back and forth with the client on this last week. This came out when, Friday or yesterday?
No, this came out yesterday.
Okay.
Yeah. And
we were waiting to see what happened, so this is a good update.
Yeah, this will be a good one. Yeah, so we'll have a note out on this later today, and the one area, ironically, I guess, the one area where standards continue to ease, which is a good thing, is on residential mortgage lending. That's sort of the good news, is that it's getting a little bit easier to obtain mortgage credit.